What's up, people? Welcome or welcome back to Invest with T Claus. My name is Tevi, and this channel is dedicated to my investment journey, along with coverage on crypto, Tesla, Neo, Virgin Galactic, and ChargePoint. Come for the information and stay for the perspective. So we are officially in December. It's hard to believe the year is almost over, but here we are nonetheless. Lots of discussions around whether or not we are going to get a strong year-end rally. On one hand, inflation seems to be moderating. The next CPI reading is on December 13th, with expectations of another decrease, which aligns with Powell signaling this week that small rate increases are likely to start in December. That is all good news. On the other hand, major indices are up over 10% already since the new bottom was placed in October. So can we drive significantly higher from here? I would say probably not. This then brings us to ChargePoint. Between the broad market sell-off we saw on Friday as a result of the stronger than expected job report and the fact that ChargePoint missed expectations, the stock closed the week down 2.92% at $11.64. So in today's video, I'll go over my main takeaways from the earning call this past Thursday, cover where the analyst consensus and price targets are, and tell you why this miss, in my opinion, is a good thing. So, as always, this isn't to be taken as financial advice. I am not a financial advisor. This is my personal approach to investing and a thought process behind it. I'd recommend watching all the way through so that you don't miss out on any pertinent information I'll be sharing. Drop this video a like if you haven't already, and smash that subscribe button. Those are two easy ways to show your support to the channel and help it grow if you appreciate the content. All right, let's get into it. All right, so let's start with a reminder that ChargePoint is not yet profitable. However, unlike Virgin Galactic, they actually have sales. So at this point, what I care about when listening in on these earning calls is this. Are they growing their customer base? Are they growing revenue? Performance around gross margin and operating expense? And finally, the forward guidance, right? So during the call, Pasquale Romano, the ChargePoint CEO, made the following statement pertaining to customer acquisition, and I quote, "We continue to add customers at a rapid clip. Our consistent expansion with existing customers was over 65% of our billing for the quarter, consistent with the historical trends, and we now count 80% of the 2021 Fortune 50 as customers and 54% of the 2021 Fortune 500. End of quote. For reference, last July, they reported 53% of the 2021 Fortune 500 companies as customers. So that's a 1% increase quarter over quarter. That's a positive. Looking at revenue, that came in at $125.3 million. That's up 93% year over year. But the analyst consensus was for $132 million in sales, so they missed on the top line. That said, EPS, or earning per shares, came in better than expected with a loss of 16 cents versus the expected loss of 19 cents. Gross margin improved on a quarter-over-quarter basis from 19% to 20%, and operating expense as a percent of revenue further decreased to 63%, that's the orange line you see there, from the previous quarter. So why does that matter? Well, in order to reach profitability, you need revenue to grow while operating expense decreases. So from that standpoint, ChargePoint is also doing well. So that's for this quarter performance. Looking forward, they maintained their Q4 revenue guidance of 160 to 170 million, with a full year revenue guidance range revised upwards by $5 million to now 475 to 485 million. All in all, it was a pretty good quarter. They are still experiencing supply chain issues, but it was encouraging to hear that it was 1, improving with less and less components being an issue, and 2, the issues they actually ran into were more on the ChargePoint execution side rather than not being able to source what they needed. So at the end of the day, what I was really looking for was confirmation that they still saw a path to reach profitability by 2024, as previously communicated. Pasquale covered it in his opening remarks, as you can see on the screen here. So personally, as a long-term investor, I was satisfied with the reported results. That said, I did start my comments with the fact that ChargePoint missed analyst estimates. I can't stress enough that missing analyst estimates doesn't necessarily mean that the company did poorly. Sometimes analysts simply suck at forecasting, so take the notion of a miss or a beat with a grain of salt. Now, despite missing analyst estimates, ChargePoint results impressed those covering the stock enough to flip the consensus rating from moderate buy to a strong buy. We now have 4 buy ratings, 1 hold, and 0 sell. The price target range from $28 on the high end to $14 on the low end. The average consensus price target of $20 represents a nearly 72% increase from the current levels. That is not negligible, okay? So it would be fair to say that the upside potential and the associated ratings all sound great, but this is one of those instances where paying attention to the near-term noise could actually play in my favor. Let me pull up this chart here and I'll explain what I mean. If you recall, we had our golden cross back in September. The 50-day price action crossed over the 200-day price action. This was a bullish signal, right? Now, that spike took us all the way to $16.14 before we ran out of steam. We've been trending down ever since, and we finally had our def cross. So a def cross is defined as the 50-day trend line falling below the 200-day trend line, which is a bear signal near term. And with that, let's pull up another chart for a more granular view. It's a bit more busy, but I'll explain it. Ever since our golden cross, we've made a series of lower highs. It's the arrow you see here, 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 and here. Add to that during November, we visited the $11 to $11.50 price range on several occasions. It has proven to be strong support for the stock, and we've avoided falling below that critical level ever since the May low of $8.50 was put in. So the issue I see here, and the reason I'm not rushing to buy this go around, is this. With an over 10% move to the upside already, the broader market rally will likely run out of steam soon. We're right up against the 200-day moving average at the index level, so the S&P 500, NASDAQ, and Dow Jones. Powell just this week said that they would keep monetary policies tight until real signs of improvement on inflation are confirmed. That means basically that you need a trend of at least 3 months of improving data. Basically, we're looking at next year. Then there's the fact that the ChargePoint stock is currently trading at above 8 times 2022 revenue, which for a non-profitable company could be considered a rich valuation. So even if I personally feel that's reasonable, technical traders and those who focus heavily on fundamentals may not be buyers at these levels, which brings me to why the miss is possibly a good thing for long-term value-minded investors. The market is showing signs of exhaustion. We have a full trading week before the CPI number is released, yet ChargePoint is already near support with seemingly bad news in the form of the earning miss. I am more inclined to sit this one out and see where we go rather than jumping in here and buy. Even if the stock was to move a bit higher, the move would likely not be sustained. So the bottom line is this. I suspect that we'll see another broad market sell-off in the coming weeks. I don't believe ChargePoint will put a new low. However, it could likely go below the current support level, even if just briefly, and provide a better entry or buy point at $10 or less. There is absolutely, and I mean absolutely, no reason for me to rush with the current market condition. I'm estimating that between now and end of Q1 2023, we'll see one more broad market sell-off, and if recession hits next year as widely expected, then that will be the time to go in heavy. Why? Because at that point, assuming inflation continues to drop and unemployment rises a bit more, it'll be more appropriate for the Fed not just to pause interest rate increases, but actually reverse them to stimulate the economy. And so with that mindset, the last thing I will say is this. Even though I expect that I still have another 3 to 4 months at this point to be selective on entry points to accumulate what I want, the reality is no one, including Jay Powell, actually knows when it'll be appropriate to pivot from a restrictive monetary policy to an easing policy. So the main takeaway is this. ChargePoint is delivering what I expect for me to feel confident that this is still a solid long-term investment. The short-term noise this miss has created or is amplifying, depending on how you want to look at it, will likely allow for an even lower buy point. So a bit of patience here is likely to go a long way. But on that note, that is it for me today. Don't forget to drop this video a like if it helped you gain a new perspective and share with others who you think could also benefit from it. For my newcomers, subscribe and don't forget to ring the notification bell so that you too can stay in the know. I'll be back on Sunday for my weekly video. Till then, you can keep up with me here on Twitter for crypto and NFT related news. Thank you for watching. Stay humble, hustle hard, and I'll see you in the next one.